And what happened is the investors that were long-term, like we were, and didn't redeem, got left holding the bag.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time.
Welcome, everyone, back to Alt Investing Made Easy. We're continuing our conversation with Larry Powell that we started in our last episode. And today we're focusing on his rules to live by that he's developed in relation to evaluating investment managers and evaluating money managers. So let's just get straight to it. Thanks again, Larry, for your time today.
Absolutely.
Okay, well, I'm going to bring up the presentation. And Larry, just let me know. We'll start with the title here and just I'll go ahead and advance it. But here we've got rules to live by. These are rules for asset allocation, how to evaluate external managers of your money. And really these apply to no matter what type of alternative asset, whether we've got a hedge fund, a private equity fund, or a real estate investment fund. If somebody else is investing your money for you, then these are rules that Larry has developed. So, Larry, just please take it away. I'll advance to the first slide.
Yeah. This is the most important one. A manager is guilty until proven innocent. Go into the meeting skeptical. Just because the manager has a long track record and claims to have a lot of AUM does not mean that he or she does. Most managers are smoke and mirrors. Track record is only part of the equation. They tell you what they think you want to hear, so be careful what you tell them. That integrator, I've already talked about some of this stuff in my description of how we built out Texas Teachers, but unlike the court system of the United States, a manager is guilty until proven innocent. So and a lot of that is learned by listening to the long story, talking to other people, other investors, other asset owners. And an asset owner is like a pension fund, endowment, or a foundation. But other people that have invested in this manager, that it's critical to develop a network of of like-minded investors that you can reach out to and talk to about a particular manager. It's kind of funny, as a due diligence expert, as someone who's allocating capital to outside managers, it's a little bit like being a Karen. You gossip with your counterparts, your peers in the business. I remember when a guy called me up and he's like, "Hey, did you hear that so-and-so got divorced or had an affair?" And, it was kind of funny, but it was really important because, when a manager, when a manager goes through a divorce, a lot of people will redeem from that manager because and I know this personally, it's a really tough time, and your eye is off the ball, and your eye has to be on the ball all the time. But anyhow, throughout my career, I've come across a lot of posers, a lot of frauds. I've come across posers in the actual allocator world, the asset owner world, family offices and things like that. It's It's actually a really big problem. Right now, there's a lot of groups that claim to be family offices, but aren't really family offices. But I think it's critical to go into a meeting skeptical. And, that manager has to prove themselves that they're worthy of your money. Trust is the most important thing. Track record is not. If you talk to any allocator, they will tell you that performance is down the road. It's down the line, or, at the lower end of the totem pole than at the high end of the totem pole. You wouldn't be talking to the manager unless they had a good track record, but it's only the beginning, and when you sit down with a manager in their office, that's where you learn, a lot of this stuff, right? And as I mentioned in the last episode, building that mosaic, right? You have to build a mosaic, and just like you would if you were evaluating a company, as a stock picker, you're building a mosaic. And on the manager selection side, you're doing the same thing. And if there's just one thing wrong, then, you might as well just pass on that manager, because as you said, Roland, you're relying on this manager to manage a lot of money. If you're someone like Texas Teachers, or you're an endowment that's $2 billion, you're allocating $50 million or $25 million, whatever that number is, to a manager. In your eyes, it's a lot of money. It doesn't really matter. Or if you're if you're allocating money as an individual, it's really important that you do your own research. And, and that's something, it's something that's really important, and has always been really important to me, is that the people that work on your team are doing their own due diligence. They're not relying on their outside consultants. Pension funds have board consultants, and they have consultants for pretty much everything. For the most part, because they don't want to pay the people that work there, and it's off balance sheet expenses, or off income statement expenses. But anyhow, for me, as a manager of a team of people that are evaluating, money managers, that you live and die by your own sword, right? If you make a decision to invest in a manager, well, it's great if it works out well. It's not so great if it doesn't work out well. But you can't just say, oh, well, the consultant really liked this manager. And because the consultant is just going to, go like this, if something happens to a manager, and it's like, well, it is what it is. I mean, this has happened in history throughout, throughout the years, that consultants will recommend a manager. But, when the fit hits the sand, as they say, they're nowhere. They've just walked away, and it's up to you to make that decision. That's the other thing, is that if you haven't done the due diligence and you don't understand what that manager does, and they go into a drawdown, every manager is going to go into a drawdown. Everyone. I don't care who they are. At some point, they are, they're going to have a loss in their portfolio. No matter how well they've done in the past, they are going to have a time where they don't do well. And you have to make that decision, right? Do I keep this manager, or do I not keep this manager? And all this stuff that I'm talking about here is smoke and mirrors. It's all about detecting frauds. People, boards and things like that, give you less pats on the back when you've avoided a manager, as opposed to when you've invested in a manager who's underperforming. There's a lot of managers that asset owners, allocators, due diligence people will avoid, but the board may not know that they avoided that, that particular manager, because that manager is not in the portfolio. Now they may hear about a manager who is a fraud or blew up or did something wrong, doubled up on an investment that was a losing investment and turned out to be an absolute, hole in the portfolio and went out of business, but I think the investment teams do not get as much credit as they should get. I think avoiding a blow up or avoiding a manager who is, not a good character, not a good actor, is more important than, having money with the best performing money manager on the planet. So that's really what this slide is all about. And just so you know, I put together, you can tell it's an awful PowerPoint. I'm not an expert. I don't claim to be an expert with PowerPoint, and it looks like a fifth grader did it. But I use this PowerPoint to indoctrinate and to introduce, or I guess whenever I hired a new person, I would go through this rules to live by. It was really important for me to understand kind of what our culture was and how we conducted due diligence on managers. I talked about in the last episode about the importance, and maybe in this one, I can't remember, in the importance of going out and sitting down with a money manager in their office. And I remember interviewing a guy, I won't mention the pension fund because they're very large, and I was shocked. But their belief was managers should come to us. The managers should fly and come to us. We don't need to go out there and meet with the manager. And so I knew within 10 minutes of meeting with this potential candidate that they were not a candidate or a prospect for my team, because we did go out and we'd spend a lot of money on travel, going out and meeting with managers and getting to know them, not just having them come into the office when they have their game face on, but anyhow, we could go on the next slide.
Okay. Just 1 second. Okay.
All right.
G-rated.
Yeah.
It's okay. This podcast is for adults.
Oh,
right.
yeah.
Yeah. Go on a few days before you jump into bed with anyone. It's critical. It takes more than one meeting to determine a manager's moral compass, which is why institutional asset owners spend so much time on conducting due diligence. One more historical incident. I had a friend of mine who's a CIO, and I'm definitely not going to mention his name. He was a CIO of a family office, and we were in Europe at the same time. And he asked me who I was meeting with, and he said, "Hey, do you mind if I come along with you to this meeting? Because I'm, interested in this manager, and it'd be fun, because he used to work for me. It'd be fun to, to do a meeting together." And I'm sitting there listening to the long story and hearing about their strategy and stuff like that. And he's already, within a half an hour into the meeting, he's asking for the paperwork to invest in the manager. And I'm trying to figure out whether I'm even interested in this manager and having another conversation with the manager. It's very different. And, in I think family offices in general are quick to pull the trigger and invest in a manager. And a lot of times, they ended up with not such great managers. And I'm not just picking on family offices in general, but a lot of people do that. They're impulsive buyers, and they're like, oh, wow, great track record, good looking suit that you have on, nice office, great, statues in the office. I want to give you some money. That's the second bullet, right? Don't be enamored by a manager's office or his toys. They may not be theirs. I actually had a meeting with a manager in New York, and I went in there eyes wide open because I had talked about, one of the things that we did that no other institutions were doing first of all, there weren't a lot of pension funds investing in hedge funds, as you mentioned, Roland, in the early 2000s. We were pioneers of investing in hedge funds. I remember I was at it's called the National Association of State Investment Professionals, and it's everybody below the CIO. Then they have NASIO, which is National State Investment Officers, so CIOs. But yeah, I was at this NASIP meeting. There were 150 representatives. It was in Austin, and there were only 2 asset owners at that time, and that was in 2003 or 4. I think maybe it was 2004. There were only 2 asset owners, UTIMCO, it's University of Texas Investment Management Company, and Texas Teachers that were invested in hedge funds. And we were talking about hedge funds, and you thought we, had 3 heads and a tail, because nobody had invested in hedge funds. But anyhow, this a meeting that I had with a manager, I had a conversation with them. As I said, we were early adopters of risk requiring managers to provide position level detail, hedge fund managers. And this is back when hedge fund managers, if you were lucky, gave you 1 paragraph describing how well they did or how poorly they did that quarter. And we were demanding that, they provide position level detail to a group at the time called Risk Metrics. And then they would crunch the numbers and produce this risk. It would do risk reports, like hundreds of pages, but, we did that. We wouldn't invest in a manager, and we redeemed from several managers who wouldn't require that. But anyhow, I'd had this conversation with the marketing guy. It was a third-party marketer. And a third-party marketer means that they don't work for the manager. They're, they have their own business, and they market multiple managers usually. But I had this conversation with the manager that we require the manager to provide position level detail. And, and we don't see that position level detail, but we get a risk report from that. And he's like, the manager only invests in small companies, and he's not going to want to give away, that he's not going to provide that to anyone. And I said, well, it's a requirement. And, I said, I think I can probably convince him to do it. So I went and had a meeting with this guy, and he had a beautiful office, pictures of, really nice artwork and stuff like that. And one of the questions that I asked him was, so tell me about a company that, you've invested. Kind of walk me through a investment from sourcing the deal or the stock and to investment, and walk me through that process. He said, okay, well, let me tell you about one of the stocks. And it was, I used to know the name of the company. It was a large cap company, right? And his guy told me that all he did was invest in small caps. So immediately I was like, what is it? Small caps or is it large caps? It was a company like IBM, and it wasn't IBM, but it was something like that. And, so that, that immediately gave me, a red flag. And, I had a hard time trusting this guy. I had a hard time trusting the third party marketer and the manager. And I was like, oh, that's interesting, because your guy said that you're investing in small cap stock. So that, that meeting did not go well. And, when I got back, I remember I was talking to some people about this manager, and I won't mention some of the things that the guy, he was going out on the town and doing things, going to bars and, but he didn't have a very good reputation. And his third-party marketer called me up, and, and I said, hey, we're taking a pass. And, we're not going to give you our due diligence questionnaire. We're not moving forward. And, he convinced me he was a good marketer. He was good, but he wasn't so good. He convinced me to give them our due diligence questionnaire. And I said to him, if there is one question that's not filled out, I'm done. There was a question in there about turnover. It's like not applicable. He gave me the thing back. It's like every question I asked was like not applicable, not applicable, not applicable. And I'm done. Well, a month or two later, it turned out he was a complete fraud. He was trading only pink sheet stocks, which are stocks that trade under $1, I think, or something like that. And I don't even know if they exist anymore, but, it was a pump and dump scheme, and it was just a complete fraud. And, that was another formative moment, in my career. But had I not talked to, some of these other people, and had I not asked them to fill out the due diligence, I just skipped right to the due diligence questionnaire. Normally we didn't give that until we were 95% sure, because we didn't want to, waste anybody's time. But I was very skeptical of this guy, and this, like I said, the marketer was very persistent. And, so I just skipped right to the due diligence questionnaire when it came back with almost everything, NA or, one sentence or something like that. I was like, I'm done. And, that was an example of where you create a mosaic. And once again, this manager had incredible performance, but it wasn't real, and, anyhow, we can, I've talked a lot about this. Talk to as many people as you can. I've talked about that in the previous episode.
Yeah.
So we can just move on to the next slide. Networking, I talked about that.
Yeah.
The thing, there's a lot of values to networking. First of all, if you sound smart or think outside the box, people respect it, and word will get out of the same. Now, these are things that I'm telling to my team, right? And I'm not just telling it to them, I'm telling them for more reasons, for their career, right? I'm just talking to them about their career, right? Because I know they're not going to be here their entire career. And, for me, when people leave, a lot of people, I guess, view that as criticism for your management or whatever. But, I remember I had a guy at, when I was at Utah retirement after Texas Teachers, and, he was probably the smartest guy on my team at the time. And, I was worried, I felt like I'm going to have a huge hole in my team when he leaves. But at the same time, I was flattered because he was picked off by MIT, the endowment, which is well known in the asset owner world for being one of the, smartest group, in the sector. And so, first of all, I was happy for him. He was a personal friend of mine, the guy that worked for me. And I thought it was a great move for him. He got to move back. He got to move back to where his family was, and he was joining an incredible organization. And the funny thing is that when he was at Utah, he was all about quant. He was all about quantitative statistics, analytics, and everything. And I was all about art, and he was thinking about kurtosis and Sharpe ratios and, all that stuff, probably 90%. And then he came back 2 years later, maybe a year later, and we all sat at a table and he talked about MIT. It was all art. They didn't even have software, and they still don't, to evaluate money managers' performance. Historical performance to them is not important. It's all about, do they have the right process? Do they have passion? Things like that. Art.
Qualitative.
Yeah. And, their motto is there's no manager who is, it's on their website. The bottom line is they will hire a manager without a track record. All they really care about is what's in their portfolio, why it's in the portfolio, and how they invest. No manager is small enough, has, a shorter track. I can't remember exactly what it is, but they're all about hiring emerging managers, which is what I've always been about too. Is finding that diamond in the rough. It's almost like hearing your kids sing in the choir or something like that, and you're so proud of the way they sing. For me, finding a manager that nobody knows about was more important than, because anybody can pick up the Barron's and look to see who the top 100 hedge fund managers are and go through there and just hire them. It's another thing to actually do the due diligence yourself, find somebody that nobody knows about, and allocate them a large sum of money.
I remember that, it was always said that the emerging managers are the ones that are hungriest, and that hunger is such a powerful motivating force.
No doubt about it. When managers get bigger, they get more concerned, about losing money than making money, because a lot of that money is theirs.
Yeah.
It's important to me that a manager has a lot of money, a lot of money invested alongside. That is like the number one thing about hedge funds, and the differentiation of a hedge fund versus a mutual fund where the manager may not have a dollar invested alongside. They may not be able to afford to because they're not paid well enough, or they just don't believe in themselves. I'm not sure why, but that's one of the most important things. But it can also be a negative, right? Because as the manager gets bigger, he's had a lot of his money invested alongside. It's grown organically. And, they get more concerned about losing because they have a majority of their net worth that's in their fund, and they get more concerned about losing that money, and they're managing their business, right? They don't want to take risks that smaller managers are willing to do, which is probably why performance in the earlier years is better than in the later years of a money manager's track record. Anyhow, I'm digressing.
No, that's
from,
good.
It's really interesting.
I do that a lot, but having a diversified network, like I said, allows you to leverage it for due diligence and reference checks. So that's key. And without networking, I wouldn't have the business that I have today. If
Sure.
I just put my nose to the grindstone, or to just opened up a book and or a manager's due diligence questionnaire and read that and never talked to my peers, I would not have the business that I have today. So it's really important. And I always said this to the young people that joined my team, is that you're in a great position. You're at a pension fund, you're at an endowment or foundation. The world is your oyster. Remember that. Because you can meet almost anyone you want. You can pick up the phone, and you want to meet George Soros, you can meet George Soros. Anybody, and that's really, really important. So capitalize on where you are.
That's, big asset allocator. Yeah. I mean, the guys that would come into those board meetings, I remember, the executives from the very biggest funds would come to Austin to, close the deal. So for sure. All right, well,
that was particularly on the private equity side, because, they had to, it was a dog and pony. They had to come in and, make a presentation to the board, and then the board decided how much they would get. The team would recommend a dollar amount. But what I thought was interesting, it's a lot of times the board would say, we should give these guys more money.
what a problem to have.
Yeah. But anyhow, that's a whole nother discussion.
Okay. Well, I'll advance the presentation.
Yeah, this is really important, and and I think a problem in in the industry on the due diligence side with a lot of things, right? Is people that sit in these big seats, they're worried about their career, they're worried about their future, and they may not want to offend a manager, because they may want to go work for that manager at some point. They may not want to take on an agenda like I did, when I was at Utah on alignment of interest, because they're worried about ticking off the manager. They may be worried about getting capacity for the manager, because there's a lot of the best, money managers, you can't get capacity. And, if you ask too much, well, they may not give you that allocation that you want. They don't want to offend the manager. I've never been that way. I've never really worried about career risk. I've been more worried about investing in the right managers and maybe ticking off a few. But, doing the right thing for the beneficiaries has always been my number one concern, is, am I doing the right thing? It's like, the alignment of interest crusade that I went on. A lot of people would not do that. They would not do that because they would be afraid of their career. They'd be afraid that they'd tick off a manager. And for me, it was in the best interest, in my mind, it was in the best interest of the people that I worked for, which were the beneficiaries, that I improve the balance of power and the fees that, that we're paying to these specialist money managers on behalf of, the longevity of the trust. So anyhow, a lot of due diligence people, guys and gals, are afraid to ask probing questions, but you can't be afraid. And managers, as it says here, managers respect you for asking unique or even probing questions. If they think you don't understand what they do, they're going to take advantage of you, because these are just some of the smartest guys on the planet,
Right.
and people on the planet, trying to be politically correct here.
Thank you.
There's both women and men that are very good at managing money and have been very successful at it, both on the manager side as well as the asset owner side. But anyhow, managers definitely respect you and will tell you a lot more if you ask, probing questions. They may tell you, hey, that's getting into, proprietary, particularly quantitative managers. You say you're getting into, we view that as proprietary and rather not answer, that question. But if you don't ask that question, they may not know that you really know a lot about what they're doing. And, and they can pull, wool over, or, they can direct their presentation in a way that makes you think that they're really smart, but they're not. They may be smart in creating a appearance that they really know what they're doing, but they may not be. So if you don't ask those probing questions, you may not find out what you really needed to find out until you're already invested in the manager. And so at the last bullet here, dig until they absolutely refuse to respond. And if they refuse to respond, ask them why.
It's a huge red flag if they get offended, because they have duties to their investors, fiduciary duties, and it's such a high standard that, a huge red flag if they get offended.
Yeah, exactly. And, a lot of times they get offended or they won't answer the question, particularly on the quantitative side, is because their strategy is really simple. They want you to think that it's really complicated and robust, but it's really simple. It's a bunch of moving averages crossing and things like that. And they're afraid to, admit that's what it is, and so you can learn a lot about what a manager is doing or not doing by asking them, probing questions. So there's a lot of reasons why you do that.
Makes sense.
We can move on.
Okay.
Yeah, this is this goes back to the whole mosaic thing. Triangulate and build a mosaic. When it comes to funny business, do not hesitate to redeem. If you hear something through that rumor mill, and you confirm it, you talk to other people and they confirm it, don't risk not making a move. If you have the ability to redeem, you get out. Private equity, you're locking up for 10, sometimes 15 years now.
Wow.
So you don't have the ability to do that. So you need to get all those answers before you allocate money to them. But here's another, don't throw under the rug a comment that might suggest a twisted moral compass. Whether it's, I can't give any specific examples, But I can tell you, through the long story, I've heard a lot of things that managers say, whether it's, they're gathering assets and, and that's what they're trying. You can tell that they're gathering assets just by something that they're saying, or, they've done something or they mentioned something in the past that is just doesn't sound good for one reason or another. Just don't invest, and or get out, and like I said, these are some of the things you learn. Sometimes you learn down the road, and don't hesitate to fire them, and don't ask questions first. Shoot them, get them out, get them out of the portfolio. It's really important, And like I said, if the manager is truly a fraud, he or she will attempt to talk you into staying in the fund. That's not a golden rule. It's not like every manager who tries to keep you in their fund is a fraud. That's not true. But if they are a fraud, they'll try to keep you in the fund.
Well, if they're substantive and confident, then they should just, see that maybe it's not a good fit. I mean, why would you want an unhappy investor to stay?
Well, I'll give you another example. This guy wasn't a fraud, and I'm definitely not going to mention his name because I was talk around the office for many years. I heard from somebody who worked for him. But we had a manager that was an activist, and he was in the Wall Street Journal all the time. And I had some issues with him because he told me one thing, and he told me he was willing to negotiate in the, nadir of the market in 2008. And once things started recovering, he wasn't willing to. And that, kind of gave me a bad taste in my mouth about his moral compass, and there were some other things that he was doing, moving to trading in different markets than he had in the past, and kind of trading in a way that was different than what he had done in the past. But one day, one of my guys, this is when I was at Utah, one of my guys came to me and he's like, oh my God, he's in the Wall Street Journal again. And I just said, redeem. And I'm sure he'll never watch this podcast, so I'm probably pretty safe saying this, but we did. We put the redemption. When you're at a public pension fund, you don't want to end up in the newspaper. You don't want one of your managers ending up in the newspaper, right? Because it could shut down the entire program. And so we redeemed, or we put the notice in to redeem. He called me up right before the redemption was going to be final. And I didn't answer the phone. And it was not because I wasn't in there. I mean, it wasn't because I knew it was him and I didn't answer the phone. It was because I was out in the meeting or something like that. But he left a long message on my voicemail. And he's like, I know you're going to regret redeeming from us. I don't know why you're redeeming from us. We're the best manager in the world. You're going to look back at this and it's going to be the biggest mistake of your career. And he just went on and on and on and left me like a 20-minute voicemail about how great he was. And I was so glad at that point. I was so glad that I had redeemed because, I had a policy of not hiring, how do I say this without getting bleeped? But it starts with an A. I had a no A policy. And clearly after that message, it didn't help him, and we would never have rehired him. But anyhow,
Huh.
that's an example of a manager that we redeemed from, and he tried to, talk us out of redeeming. We can go on to the next slide.
Okay.
Yeah, this is really important. Your male and female intuition is usually correct. Don't discount it. George Soros used to close out positions when his back started to hurt. So I remember this. I was had done tons of due diligence, 6 months of work, and legal had done 3 months of work. We were about to allocate money to this manager, and there were just some things I don't remember exactly what it was, but there was just some things that didn't make sense. And in my gut, I thought it was the wrong thing to do, give this money to this manager. And my gut was right. I couldn't sleep at night, and there were just some things that they said that I remembered that just didn't make sense to me. And the manager ended up closing shop 6 months later. So I was right. And, intuition is so important. It just goes back to whole art versus science. It's the most important. It's one of the most important things. If you don't follow your gut, you're really going to be disappointed if something happens and you're right. So follow your gut.
That's good.
That's
Go to
great
the
advice.
Yeah. Transparency. Transparency was like number one. And, when I was at Texas, it started in Texas Teachers and it continued to Utah Retirement. And I'm particularly in hedge funds, previously back in the 2000s and the 90s, you had no transparency, none. These guys could do anything they wanted. There's lots of ways to mask true performance without transparency. Short selling options was something that was really, really big. And it smooths out your return curve, but it also, if you do it in the wrong way, it puts your investors at risk and your portfolio at risk. And I'm convinced that there are a lot of managers that were used to shorting options before 2008 in an extent that produced leverage in their portfolio that this caused the stock market to go down more than it would have had they not been shorting options in their portfolio. But there's a lot of private investments that you don't know about, that if you don't have the transparency, you won't know about them, that in your portfolio. And they use the leverage, a lot of levers that can be used. If you don't have transparency, you don't really know it's there.
Interesting.
Yeah.
What's disclosure? I mean, we talk with clients about that all the time,
Yeah.
that, you have an obligation to disclose everything material about the investment, not fail to disclose anything where the failure is material. So, I guess it's hard to detect if they're doing it and not disclosing it, but,
Yeah.
Seems like this
I
would
got
go
plenty of-
online with if you got a money manager who wants to be transparent. That's a pretty good sign, isn't it?
Yeah,
Like,
it is. And, and it's another fraud detection. I could go on and on. I mean, there were a lot of managers that we avoided when I was at Texas Teachers because they wouldn't go on, they wouldn't provide us with that level of transparency. So we passed on them. Yeah, I mean, this is kind of take up from the previous discussion about the FX manager that turned out to be a fraud. One of the advantages that I had in that situation is, as I mentioned, I ended up not losing any capital. And the reason that I didn't lose money was primarily because I had a separate account. And, I knew exactly what they were doing. I could see the trades that they put in and things like that. But, that's one of the big advantages of managed futures and FX is, most of the managers, although some have commingled funds, a lot of them will do an SMA, and you can get it onto a SMA platform. Separately managed account is what SMA stands for. It's just a much more efficient way of investing in hedge-like funds, and the risk of fraud, as it says, is close to nothing.
Well, we may want to just pause here because part of this is an investor education effort. And so distinguishing between a managed account, you've got a manager that has a strategy and you've given him authority, trading authority with respect to an account that's still titled in your name, but he just has the trading authority. And that's distinguished from you investing in a fund where the funds, you turn it over to the manager, he deposits it into the brokerage account in the name of his fund that he controls. So that redemption process requires the manager to take action versus in a managed account, you just being able to turn off his trading authority at your discretion.
Yeah, that's exactly right. A lot of commingled funds have monthly withdrawals or even quarterly withdrawals. Whereas in a managed account or a SMA, separately managed account that is either in the name of the platform that you're working with, the managed account platform, or it's in the name of the actual asset owner that is delegating discretionary authority to a manager. And that's the big advantage of an SMA, is that you can shut it down in it. As long as it takes to liquidate the portfolio, you can shut it down pretty quickly. And it's one of the things that I guess the tenets of the multi-PM hedge fund manager like Citadel or Millennium, any of those groups, it's just a much more efficient way to utilize your capital and be able to leverage your capital or deleverage your capital. And like you said, you have full control. So you can get out at any time. You can see what's in the portfolio. And that's really important because in a lot of commingled funds, a nickname for a commingled fund like a offshore corp or a limited partnership is a blind pool. Because you can't see anything in it. So you don't really know what that manager is actually doing unless you have full position level detail into that commingled fund. And although that's a lot more common these days, it wasn't 10 or 15 years ago, 20 years ago when Texas teachers first got into hedge funds. So, it's a lot more common today to get an SMA. It was hard, even when I was at Utah Retirement System between 2008 and 2014, it was hard to get a manager to do a separately managed account. I mean, the willingness of a manager to do a separately managed account between 2007 and 2008 was like night and day. The great financial crisis really brought to light some of the risks of being in commingled fund, in a commingled fund versus an SMA. And since then, there's been leaps and bounds in terms of acceptance but as well as understanding the benefits of doing an SMA. And there's lots of these separately managed account SMA platforms that have popped up. There was only 3 or 4 of them in 2008, and I couldn't even tell you how many there are. I would imagine there's 50 to 100. But I don't really know. There are quite a few of these platforms around, and a lot of the investment banks have gotten into it, and it's a good business, and it's a lot more efficient for the allocator to allocate capital.
And it sounds like it really was sort of in response to growth of these platforms, in response to investor demand.
Yeah, and I think it was also cost. I know that we took a look at it when I was at Utah Retirement back in 2009 and 2010, and we were a big investor, and yet they wanted to charge almost 100 basis points to get on a platform. And today, you can get all the legal done for each of the different, legal entities inside the platform for like $15,000 or $20,000. And, so you'd probably have to open up one of those for each of the accounts, so they're segregated and ring fenced and things like that. But the actual cost, the basis points fees have come way down. And, I'm not in that seat anymore, so I don't really know what those fees are, but I know they've come down a lot.
Well, and, we don't work real extensively. We do have some hedge fund clients, but maybe not big enough to where, this becomes an issue, but it's good. It's worthwhile knowing and understanding that this is a mega trend in the industry, and that, when you and I were working together, it was a while ago, and things have changed in the marketplace. So this is partly investor education, partly this is Roland education too. Yeah. So I really appreciate it.
Yeah, absolutely. Absolutely.
Okay. Well, anything else on this slide, or should we move forward?
No, I think let's just move forward. I think we covered that. So.
Okay. The OTC markets are unregulated.
Yeah. Well, so that goes back to the whole discussion that we had on the last podcast is, the FX markets. They are over the counter, and they are somewhat unregulated. Today, I think they're more regulated than they were back when I made that investment. And I'm not sure who regulates them. I think a lot of people are questioning, who regulates swaps, we know who regulate futures, CFTC and the National Futures Association is the, I forget what it's called, but SRO.
Self-regulatory bodies. Well, I guess the CFTC is a government entity, but I bet the Futures Association is kind of like FINRA, I guess, a self-regulatory agency.
Exactly. Self-regulatory organization, I think is, I think that's what it stands for. But yeah, and this has become a big issue, right, with Bitcoin and things like that, like who regulates, who's overseeing that. And so, there's a lot of things that have changed and improved with over-the-counter markets, but, they're for the big boys.
So buyer beware for sure, and make sure that, you have adequate legal counsel. It's kind of a pitch for our services.
Yeah, exactly. Yeah, know who you're playing with.
Okay, we'll move forward.
Yeah.
Okay.
Yeah, so, this one's a little bit outdated, right? Because a lot of managers have opened up shop in Miami and other areas in Florida, with Citadel being one of the bigger ones going there first, and then a lot of managers have followed. But this is something that we thought about a lot back when I was at Utah and at Texas. There's really three reasons why a manager would set up a business in Florida: quality of life, no state income tax. That's all good. We have that here in Texas. But the bankruptcy laws, and, the fact that I'm pretty sure that O.J. Simpson had a house in Florida because they couldn't take it away from him. So there were a lot of protections to that. So, this is something you really have to kind of rethink, is certainly the offshore havens, can be questionable. But Florida's a new one. So, we may have to ditch this slide. I'm not sure. What?
Well, and I think that the point is a good one no matter what. I remember, this probably becomes part of the overall evaluation, and we're really, Sarah and I have been talking a lot about this idea of the long story, but the long story includes where the manager has his office and how nicely he's got it finished out. And, part of it is, you can tell things about where the manager's priorities are for, where they're located and what kind of offices they maintain. So, I think the point is good, even if maybe, it
Modified is the word. We might have to modify that a little bit, but it's still, it is still, it's still an issue. It's interesting when I think about it. There was a manager that we were invested in at one of those previous shops that became a problem for us. Let's put it that way. Back in 2009, they did extremely well in 2008, and there was a big run on the bank of that particular manager. All the fund of funds, suspended or not suspended redemptions, redeemed in 2008. And this particular manager had multiple MFNs and multiple side letters. And, in the side letter that we had at the time, we didn't want an investor to be able to pull money without taking an in-kind allocation. So there's a lot of illiquid assets in this particular manager's fund. And what happened is the fund of funds had a different type of side letter, which said, we don't want any in-kind transfers. And what happened is the investors that were long-term, like we were, and didn't redeem, got left holding the bag. And it went from having maybe 10% of illiquid assets, investments, to 80 or 90%. And that was, but the reason I mentioned that is during the process, as we basically shut down the fund is what we did. We shut down any further redemptions. Us and another, a few other investors, allocators got together and forced the manager to stop, handing out redemptions. And we were meeting with this particular manager in New York, and I remember, and this is where, it's really critical to be a good listener. His assistant said, I think he's going to be staying at such and such, or he couldn't make it because, I don't know, something was wrong with it. May have been like during some major storm or something like that, and he was at his hotel, and he couldn't get to the office. And I was like, hotel. Why is he at a hotel? Doesn't he live in New York? And as it turned out, he lived in another state. He lived in the Midwest. Of course, he never disclosed that. All three of the principals lived in a different state. And we didn't know it, and neither did any of the other investors. Needless to say, that turned out not to be a good investment. I think they were up about 50% in 2008, and it looked like it was the best investment we'd ever made. And it turned out to not be a good investment. I don't really know. They were still winding it down when I left 6 years later. So anyhow.
Well, that point is a really good one, Larry, and just to again for the investor education purposes, noting MFN is a term that Larry used, and what that stands for is most favored nations. And so these fund managers always retain discretion to enter into side letters that allow them to vary the terms of the investment without notice to the other limited partners, provided that the other limited partners' rights aren't prejudiced. And it sounds like in this instance, if you're giving somebody the right to not be redeemed in kind, where, to be redeemed in kind means that it's just what you were talking about, that the manager might fund the redemption request with an illiquid asset. And so, like you said, you wind up getting, holding the bag. So that's just one thing that applies across the board, that the right of a manager to enter into a side letter. And then as an investor, I would always recommend people ask, well, does anybody have most favored nations provisions, or can I get most favored nations provisions, which means that nobody's going to get more favorable rights than me.
Yeah. And believe me, we got them. But what we were given was not what they actually had. So it was outright fraud. I mean, well, and something that typically, and you remember this, at TRS, it would, we would probably spend 3 months on legal due diligence. And we did the same when we were, for the most part, when I was at Utah. So at both places, we had a very extensive legal due diligence process, and but nothing can protect you against fraud. When it's outright fraud, like Bernie Madoff or other groups, other fraudulent asset managers, there's nothing you can really do. Unfortunately, all you can do is sue them, and by the time you get to there, they probably don't have any money left.
Always seemed like the biggest risk is that somebody's just running a fraud and it just goes undetected, and that has happened, as we know.
Yeah, and that goes back to the whole SMA, right? Doing an SMA, you wouldn't have that problem because you'd know exactly what was in the portfolio. Like with Bernie Madoff, he was running we don't know exactly what he was doing. It appears that he wasn't doing anything except for taking in money and spending money on his own. But when you invest in a feeder fund or a commingled fund, you have no idea what is actually in that fund, and therefore the level of due diligence when evaluating a manager like this in a commingled fund versus an SMA is a lot more extensive in a SMA versus a commingled fund. And there are no surprises because you know what's in there. I think one of the problems, this going off on a bit of a tangent, but it kind of applies. In 2008, there were a lot of managers that were shorting puts, and had done that quite successfully throughout the years before 2008. But, in 2008, there was just no way out, and volatility was through the roof. So even though they were shorting puts, they were getting crushed on the marks because volatility, was exploding. And who knows, maybe they sold more than they, rather than just selling enough puts to get long stock, they may have sold more than they wanted to get long, and therefore they were leveraged. But, I'm convinced that, and this goes on to a whole nother subject, but in 2008, that the stock market went down a lot more than it would have gone down had the investors not been able to suspend redemptions, because managers were just liquidating assets, and at whatever bids were available, they were getting out of things and marking those, assets to Armageddon, before a lot of the investors got out. And, one of the things that we capitalized on as a large institutional investor was the psychology of investors that were just bailing out. And we were able to buy assets sometimes at 70 or 80 cents on the dollar, and unfortunately some of our peers were on the other side of those trades. Unfortunately for them, fortunately for us, we had liquidity, and we were able to make some really good investments at, like I said, at 80 cents on, even after 2008. I mean, it went on for a long time, but anyhow.
Oh, that's fascinating. Opportunity in the marketplace. It just goes to show that even, in the midst of a crisis, that you all were able to capitalize on it.
Yeah, we were fortunate.
Okay. Well, here's the next one. Verify, do not trust.
Yeah, it's interesting. This quote on the top: believe nothing that people tell you, half of what you read, and everything you know. As a kid, after playing hockey, when I kind of slowed down on my hockey, I started racing go-karts. And it was actually the owner of one of the go-kart shops that told me this. I was talking to him about, this exhaust pipe or this clutch or, whatever it was. And it was like the pipe of the, it was called the exhaust pipe of the month, or the clutch of the month, or the cart of the month, the engine of the month. And he said he gave me this advice, and it's great advice. I'm giving this advice to my kids and to everybody. It's like, believe nothing of what people tell you. Half of what you read, because, some of that has to be documented, but everything you know. And it's really a lesson on due diligence, right? If you haven't done the due diligence yourself, you haven't done any due diligence. You may have a consultant or someone like that you're relying on to do the due diligence. But if you haven't done it yourself, then you don't really know. And that's what this really applies to, is doing your own work. Knowledge is power, and doing your own work is a lot more important, or is very important, not to just rely on your consultant. Do your own work, and you're going to be a lot better off. And it's something I instilled in my teams at both Texas and at Utah, is wean yourself away from relying on the consultant. When I I don't think we even talked much about Utah or me going there. But, when I joined there, although they were doing a lot of due diligence, they were getting all their ideas for managers from the consultant, and they were relying a lot on the consultant for doing due diligence, but they also did due diligence to kind of fill in the cracks. But the problem is if you don't do your due diligence, when problems arise, when there's an issue with a manager or whatever it is, and you haven't done your own due diligence, then you're not really going to know what to do, because the consultant is just going to wipe their hands and say, it's your problem, deal with it. And that's just the way the world works. So anyhow, that's what that bullet represents.
Well, it's good, and just something that came up in a discussion that Sarah and I were having today, and we referenced you actually again, going back to the long story, that the salespeople, which it sounds like, to a degree, that's what the consultants are doing. They're trying to sell you on these ideas, but they are going to tell you, they're going to kind of imagine what's going on inside your brain, and then try to tell you exactly what they imagine you want to hear. So that skepticism is something that is that's really good advice.
Oh, the guilty until proven innocent?
Yeah, that's right.
Yeah, no, it really applies in the alternative investment. I was talking to a friend of mine that I've known him for 20 years, and he's a institutional allocator. And we were talking about the difference in due diligence, and he runs all alternatives for a big pension fund. So he's in publicly or marketable alternatives, which are hedge funds, and then illiquid hedge funds like private equity and real estate and infrastructure and stuff like that. When you're making investments and private credit, when you're making investments in some of these illiquid assets, you're putting your money away for 10 to 15 years. So there's really nothing that you can do if something goes wrong with that investment. So, but in hedge funds, you're constantly, and marketable alternatives, you're constantly monitoring your investments, and, follow-up due diligence, post-investment due diligence is very underrated and very underused. People have really good processes for evaluating hedge funds and investments before they go in, but their processes are not so great after they've made that investment. And there are a lot of really good allocators out there that do have good processes for, staying in touch and keeping up on what's going on in that portfolio. And they may be calling them every month, or if something big happens in the market, they may call them up and follow up on that. They may be doing it quarterly, but they are following up. But there are a lot of investors that don't. And, that's one advantage. It is a big advantage to investing in hedge funds, is that if you have to get out, you can get out. But if you're in illiquid assets, you can't get out. You're stuck. So, I've always said that, doing due diligence on, and investing really, and ongoing due diligence in a private equity fund is like second grade math to, a hedge fund, because you're constantly doing due diligence on the manager. Whereas with a illiquid investment, you're doing a lot of upfront due diligence, and you're relying on the manager, and their reputation and things like that, but there's no way out. And these days, a lot of illiquid managers, private equity managers, are, exercising their extensions. So it may have been a 10-year fund when you started, but by the time you're done, it could be 15 years. You just, you don't know. So anyhow, that's another little lesson.
Yeah. And then, it's continuing due diligence. If you do have the opportunity to redeem, for sure as an investor, it's advisable to follow up, and, you need to decide, hey, is this something that we want to exit out of? But I would suspect that the manager in something that does have liquidity terms like that, they have a continuing obligation to disclose. And I would say that, they really need to be forthcoming, but for sure, like you're saying, investors can take a much more assertive approach and say, hey, we need this information from you or else we're going to quit.
Yeah. I mean, there's lots of things that will make investors, even though, asset owners and other intermediaries that are working on behalf of asset owners. And when I say asset owner, I mean the people that actually have the capital, like pension funds, endowments, foundations, insurance companies, et cetera. They own, they have the capital. And then the intermediaries are the consultants and the fund of funds and even multi-PMs these days, because multi-PMs are really just a better fund of fund model, but the like I said, the asset owner actually has the assets, and they need to be very careful, about how they have these processes and follow up processes and things like that. So,
and we were talking about this second bullet point as well today, that of course, the references that the managers will give you, they're only going to give you references to people that are going to say nice things about them. Yeah. But use your network, and you can, maybe cross-reference and find out either good or bad, but it'll be with respect to information that's not coming from the manager. So again, it's that long story and really listening to what people are telling you and try as much as possible to triangulate and figure out, is this somebody that we can really trust and believe in?
Well, yeah, I mean, that's what manager due diligence is all about, triangulating and creating that mosaic. As I walked through the first manager that I allocated money to turned out to be a fraud, right? And as I walked through that mosaic and the different pieces that just kind of fell together and caused me to vote with my feet and, pick up the phone and just shut it down. And I was fortunate I did. Otherwise, I would have ended up like some of those other investors 15 years later, So, yeah, and I was going to say that the long story, that's the beauty of the long story, is that you get a lot of references that you wouldn't probably get from, the manager's reference list. And, that's a valuable tool.
Well, I know that Sarah and I are going to be using that again and again. I mean, we filmed more episodes since we talked last, and it's funny how it comes up. And you're in the working primarily in the world of hedge funds, but other private assets as well, and just applies across the board, no matter what asset class. With these private securities deals, these are great. We're going to refer back to Larry's rules to live by, I think, for a long time.
Yeah, I mean, the long story, it applies to everything. When I was at both TRS and Utah, I mean, I could be meeting with a quant equity manager 1 minute and a reinsurance manager the next minute and an infrastructure manager in the next minute or hour. And I use it for everything. I mean, I wouldn't even start a meeting. I would not allow a manager to start a meeting without telling me their long story, because I couldn't. It doesn't really matter what asset class you're in. It applies to everything. You need to know, well, how did this person get to where they are today? And why? And there's just so much you can learn from them. And another thing is that I was a big believer in geographic diversification, because particularly, and I think this applies to all asset classes, managers, that they all have mentors. And, if you're to go up to Dallas, one of the things that I found when I first joined TRS is that there was a very well-known, I can't remember their name right now, but very well-known short seller. And they had offices up in Dallas. And as a result, and this is like from back in the 80s, these guys were operating, and the 90s, I think they finally shut down. But there were a lot of managers up in Dallas that worked or even had mentors that had worked for this particular short seller. So you had a very similar philosophy of investing flowing around in different cities like San Francisco. Also, I think it was the Feshbach brothers, but I'm not sure. But anyhow, they were also in San Francisco. So you'd have the same thing, and you had a lot of short sellers up in San Francisco. And then you have the groupthink in New York, right? You have these managers going to different idea dinners and things like that. And I mean, this isn't rocket science. This isn't like revelations. This has been going on for a long time. Or you have Tiger Cubs, that are all kind of doing the same things because they've been trained by the same person. And if you have all your money, well, let's just say it's in hedge funds. If you have all your hedge fund investments in New York, you may just have one hedge fund, that you may have 20, but you really have one. And, it's probably not true that extreme, but it's something that was really important to me as I was building out the hedge fund portfolio at Texas and at Utah, is that we had geographic diversification in our portfolio. Otherwise, we had a lot of overlap and redundant positions and redundant investment philosophies, which is really important. And that applies to private equity and other real assets and things like that, because they all come down to process. And if someone is trained at Blackstone or KKR or whatever, they all have their own DNA, and you have to be really careful that you don't have, a lot of redundancy in your portfolio.
That's great advice.
Yeah.
Well, I think this is the last slide.
Okay.
And I want to be respectful of your time. We've been recording for about 40 minutes. We got started a little late, but Larry, I just want to thank you so much. And I want to emphasize to our audience members the incredible value of the advice and counsel that Larry is giving to our audience. People pay thousands and thousands of dollars for this, and Larry's graciously given a ton of his time to Sarah and me and Alt Investing Made Easy. So Larry, I just want to thank you. It's so great to reconnect with you. We've done that a couple times, and just having this relationship, and I just know that we're going to continue to reference this education that we got through recording these episodes with you. So once again, thank you so much.
Absolutely, Roland. It's been fun, looking back at time and, lessons learned and things like that. I'm a giver, not a taker. I like to share my my knowledge.
Well, we so appreciate it. And everybody, we're going to sign off with this, I think. If you like this video, please hit the like button. Don't forget to subscribe to Alt Investing Made Easy. Remember, Sarah and I are practicing attorneys, and we can give you a free consultation with respect to any of the things that we talk about on Alt Investing Made Easy, including even hedge funds. We do have some hedge fund clients, investment advisors, and we may have to call up Larry to get his advice about how to give you the best representation. But know that we have experts like Larry that are friends of ours that we work with. And so in any event, I think we're going to sign off, Larry, and we'll sign off with our slogan that everybody needs to remember to take aim with their alternative investment strategies. Thanks so much for being here.